Okay, let me begin my webinar sharing today by extending my very high appreciation to all of you for spending your sweet afternoon to join the webinar. I hope all of you are doing well. Stay home, stay safe, and let's hope that we could work together and stop this COVID-19 chain. All right, as you can see today, I'm going to share a little bit of what we have been sharing about. If you follow our previous webinar previously, we did touch a little bit of dollar cost averaging at the very surface, not too deep into it. But today, I would like to bring you through slightly little deeper into it and bring you through the explanation behind this strategy. Indeed, there are plenty of critiques and debates when it comes to dollar cost averaging. I mean, real educational debates. Among others, some deem it as some marketing hypes to lure over fixed inflow of money solely for agents or for any or fund houses to earn on service fee. That is what I got from a lot of our my fellow advisors as well as investors. And on the other side, some question its effectiveness relative to lump sum investment. Some do compare dollar cost averaging with lump sum investment, which you invest like one time, and you don't invest subsequently after that. And today, I think I'm not going to focus on those debates, but rather demonstrate how and why this dollar cost averaging works to some extent. Given so many investment strategy in finance or investment side of things, right? I can say none of them can be deemed as the only best in any given type of economic situation. For me personally, we should keep our options open and study or examine why a certain strategy might work best in a given set of situation over another strategy. They, for sure, they do have their own pros and cons, but we shouldn't omit, any of them altogether, because no one could guarantee 100% success or profit. But at the very least, we have exercised a proper or prudent investment strategy such as dollar cost averaging, portfolio diversification, rebalancing over time. We have those strategy exercise in place. We know that we already did our best to take care of our portfolio, to take care of our investment, with the hope that whenever the market recover, whenever the market bounce, we get to enjoy the return. All right. Next, a little bit of disclaimer. Please bear with me. This is a standard procedure. I have to mention this. Please make sure that whenever you want to invest in unit trust, make sure you consult any unit trust consultant first, and try not to invest without any knowledge. Try to talk to the specialist, try to talk to the consultant, and go through the fund fact sheet, any relevant documents about the fund before you putting your money in. And the most importantly, any funds that appear throughout the slide is not for marketing purposes, but it's only for illustration. Okay, next one. Okay, let's just jump right into it. What dollar cost averaging is? Dollar cost averaging, or DCA, is an unemotional investment strategy where you invest a fixed dollar amount of money at regular intervals, regardless of the price and when you buy it. Okay, that's basically the definition. The interval can be weekly, bi-weekly, monthly, or even quarterly, whatever intervals you choose. When using dollar cost averaging method, right, unit trust investors need not be bothered with the economic situation or how the stock markets is going to perform. The main objective is to consistently purchase units at whatever the price of the unit trust is. I'm going to walk you through further into it later on. I'm sure most of you probably have heard a lot about dollar cost averaging, but I'm going to walk you through a little bit deeper into it. Okay, from this slide, as you can see, if you study the market well enough or the fund well enough, probably you get to, probably you know which fund is I'm using now. As you can see, over the last 5 years, the fund actually posted a few correction over the last 5 years, from the lowest 12.94% in the recent COVID-19 sell-off, and even up to 13.91%, up close to 14% in July 18, end of 2018, which was the beginning of the trade talk between US and China. I believe most of us agree that it's not always easy to invest in stocks or in any investment instruments when the market is declining. Concerns may develop like, what if the market continues to decline after I invest? In general, you can view it like the market moves in cycles, typically in large chunks, both up and downs. Uh, what this is what we consider to be a short time or short-lived period. As you can see, bear markets tend to exhibit a very short-lived uh, horizon. But nevertheless, no one can predict the future. No one can tell what direction the market is going to go. And while no two markets are the same and past performance is never an indication of future results, but if historical is any guide, right? We have experience, we have experience that suggests dollar cost averaging may be a worthy strategy to consider, particularly when you invest through a bear market, right? Okay, next chart. I'm going to show you an example. Let's say you decide to invest 500 ringgit into a fund, for instance, by utilizing the regular saving plan, RSP, that we offer, the FSM1 offer. You will invest on the 15th of every month. That means you are buying here, 15th of every month, here, here, so on and so forth. Okay, every time you buy, you are actually buying into varying prices or varying level of the market. So the number of units that you're going to obtain for each of your subsequent investment will also differs, right? Will also varies. Whenever the price is high, your 500 ringgit just now, uh, for that particular month gets you fewer units, and vice versa. When the prices is low, your 500 ringgit will get you more units. All right. We always hear this analogy or this concept where one going to grocery store and seeing something is on sale at the moment. For example, you see some product is having 30 or 40% discount. We surely want to load up on it. We want to buy more of it. Vice versa, when the price is high, when you notice that some products has hike up in price, you tend to buy lesser, though you need the items. Okay, most of us end up doing the exact opposite when it comes to investing. Whenever the market decline to a discounted level like this one, decline to a discounted level, let's say similar to during the recent March sell-off amid COVID-19 outbreak, it's actually the cheapest time to buy. However, most of us don't buy and decide to stay in the sideline. For me, for my fellow client investment specialists, we have seen quite a number of investors who also exited their position. They sell off all their holdings. What I could say is, volatility and emotional driven is always part of the investment landscape. You don't there's no finger pointing or nothing to blame, no blame game here. I believe emotional and volatility is always part of the investment landscape. As much as we think we are not being emotionally driven while investing, like recent March sell-off, seeing losses of 30%, of around 30% drop in a single month would definitely trigger a warning alarm within us. Regardless, new investor or experienced investor, both of us will somehow be alarmed with it. Hence, why dollar cost averaging is very closely related to this is because it works effectively mainly by protecting us from our own emotions. As you can see, if you consistently with disciplines buy into the markets at your own selected intervals, you tend to ignore this market emotion cycle. Whether it as the peak during here at the euphoria, or the market went down to depression, you just buy regardless. All right. Next, I'm going to show you three charts, which is a declining chart, a V-shaped or U-shaped chart and a rising chart, and how dollar cost averaging fare across these three different trends. Because in chart, in market trend, we always see these three trend: declining, rising, and V or U shape. Okay, this first chart is showing a declining trend. Here I have computed the difference in performance over an extended period of time between lump sum investing, invest one off and let it be, and also dollar cost averaging. We can see that if you have invested all at once, 10,000 at once, you would have lost about half your money as compared, around 50.77%. Comparatively, if you invested over time, your investment would have done better. Though you still have lost some money around negative 32%, but the loss is a lot less. All right. It's important to remember that this DCA, dollar cost averaging, will not protect you from loss. This is not a loss guarantee, strategy, but it has a potential to make us feel a very significant difference when investing in bear market. Next chart is a V shape or U shape. I'll just put them together. Let's see how both of these strategies fare during U shape or V shape trend. Here's a previous peak. Here, the previous peak in 2007. I look for MSCI All Country World Index, and during this period of time, because uh, it has a better representation of example, because this is around 7 years, yeah, roughly 7 years. The rest of the V shape or U shape tend to last a little bit short-lived period. This one is relatively longer, so that's why I use this example. Okay, if you invest right at the top before the downturn, if you unlucky or if you follow your euphoria emotion, you bought here at the very top, it would have taken you around 7 years just to break even, not making profit yet, just to break even. But if you have invested over time by practicing DCA, you would have actually made money by now. Not after 7 years, around 23.71% as compared to 0.41%. So that, because as the market went down, you would have been buying stocks or buying bonds at cheaper prices. So by the time the market recovered, you would have you have sitting on a profit. Okay, the chart is a rising chart. In this chart, there is one situation where investing a lump sum at the beginning of the trend did better than investing over time. The two example earlier, we see dollar cost averaging actually outperform, but this one is the one situation where lump sum investing is outperform. Okay, but it's logical since buying at higher and higher prices tend to drive up your WAC, weighted average cost, over time. So you will have lesser and lesser return when the market trend higher and higher. All right. There's one queries that I would like to address here. Commonly asked question by investor in regard to this. The question sounds pretty much like, okay, I'm a new to investment. Okay, I'm a new investor. I'm new to investment, and not really well versed when it comes to doing research, studying the market. If I were to start DCA, which is to avoid my emotional driven, and into particularly unit trust, which is managed by professional, means I can push my my trust into professional and leave my emotion out of it, two in one. How would I know which market or funds that I should go for that holds a potential upside in longer term? That is, for me, I think it's a very relevant question, because you wouldn't want to invest blindly. Yes, you understand DCA, you understand unit trust is to leave your investment decision to professional to handle, but you wouldn't want to invest in just any fund. You want to choose a good fund, a sustainable fund, and over the long term, you want to invest in a market that pulls kind of positive valuation and pulls a potential a catalyst that the market is going to outperform in the future. Yes, indeed. This must come with a very minimal or little understanding about the market trend, and also some prudent fund assessment. You have to be able to assess the fund whether it's good to invest or not. But don't need to worry, because you may consult the current investment specialist in FSM1. And what we do is we have our in-house research team that assess funds consistently over the years. And also they will speak to fund manager from time to time to follow up with the fund manager whether is there any significant change in the fund strategy, or whether they decide to deploy an aggressive strategy, or they decide to play a little bit defensive or conservative. So from there, we will update investors which fund or which particular market is the best to invest at the particular moment. All right. And then this is another point where I'd like to share, which didn't get as much as attention by investor when it comes to dollar cost averaging. People always think about buying consistently when we talk about dollar cost averaging, but this lower break-even point is not being paid attention to, but I think it's a very significant feature of dollar cost averaging. Let's assume that you have 1,000 ringgit that you want to invest in a particular investment instrument priced at 10 ringgit per unit. You could invest all of it at one time by lump sum and have 100 units and hope that the market or the price will climb higher. But eventually, what if the price goes down, right? To mitigate the risk, right? To mitigate the downtrend risk, what you can do is dollar cost averaging of, let's say you deploy 100 ringgit over every month, early of the month, mid of the month, end of the month, up to you. You will end up with average price per unit of only 8 ringgit. What's the key here? Your investment, even though is facing downtrend, is having loss, but whenever the market rebound, you tend to break even much faster as compared to those investors without without exercising DCA. Not just break even much faster, you actually still can get profit. So that's where DCA differ from lump sum investing. Okay, in my next slide, this I'm going to show you weighted average cost calculation in detail on how you might want to question how the weighted average cost can be lowered by investing over time. Okay, let me show you this my Excel file. Okay, this is an Excel file that I compute a simple one, a very straightforward one, where it shows the weighted average cost here actually lowered if we buy consistently over time. I choose this period from 20th February, end of February, up until early April, because that was when the COVID-19 sell-off happened. A lot of people panic, a lot of people sell off, a lot of people withdraw their holdings. But let me show you, if there's one investor who consistently buy into the market at 500 every weekly, okay, and with the surcharge, net investment amount, and the declining NAV prices, they tend to accumulate more units. All right. So the calculation is simple. You want to calculate weighted average cost, you have to figure out the accumulated unit and accumulated cost. So you divide accumulated cost with accumulated units. Okay, you divide these two, you get the weighted average cost. But in order to find accumulated, you have to add up all your subsequent investment, all your subsequent units that you obtain. Okay, so let's see at the very bottom of the market, when okay, this is the bottom. Sorry, this is the bottom, but it has hang on. Okay, sorry. Okay, let's see this at this point of time. Let's say you buy into the very peak before the sell-off, 0.7415. and you didn't do anything afterward, as compared to those which average down, they consistently buy into the market. Now their weighted average cost is 0.6439 as compared to 7415. Let's see, as of yesterday, the the indicative NAV for this particular fund is 0.6636. What is the profit and loss figure that we're looking at? Without dollar cost averaging, 7415, the investor is still seeing losses around 10.5%. But those investors with dollar cost averaging, with current WAC of 6439, they would have enjoyed a slight 3.06 profit. So this is how you calculate. If you would like to have this simple primary school Excel, I can share with you, so that you can track your investment and know where you're heading. All right. I hope this helped to explain how by investing consistently can lower down your average cost. If you follow one of our webinar by our research team back in the last few months, he explained that if you invest in every 3% drop, 5% drop, 8% drop, how much you could actually lower, how much percentage that you could actually lower from your weighted average cost. This is how we compute it. Okay, let's move on to the next slide. Okay, all right, give me a minute. Okay, I like to share this chart a lot. I like to share a lot when it comes to dollar cost averaging explanation. What we can see is okay, this is a historical uh, bull and market trend since 1929. Okay, by definition, I don't want to give you a textbook definition. Why bear and bull? Why we use bear and bull when we refer to up and downs? Because bear, when they attack, bear tend to push you down. Okay, so that's like a downtrend of the market. Whereas for bull, tend to scoop you up when they attack you. Okay. That is why people refer to bear and bull whenever they refer to up and downs. But by definition, bull markets means from the lowest close reach, right, after the market has fallen 20 or more percent to the next market high. Okay, after falling more than 20%, went up to the next high. That is bull market. Okay, whereas for bear, when the index closes at least 20% down from its previous high close, that is bear. Okay. Okay, from this chart, although the past performance is not a guarantee of future result, but we believe looking at this chart, looking at this historical trend of the market expansion and recession, it somehow helped us to gain a fresh perspective on the benefit of investing in longer term. As you can see, the average bull market period lasted about 9.1%. Okay, with an average cumulative total return of 476%. I repeat, a bull market tend to last about 9.1 years with an average cumulative return of 476%. And the average bear market, on the other hand, lasted only around 1.4 years as compared to 9.1 years with an average cumulative loss of negative 41%. Right? This impact impart a very significant or key to dollar cost averaging. If you see the downturn is really very very short lived. If you were to dollar cost average this, it wouldn't last you even more than 1.4 years on average, right? As compared to the upsides that you get to enjoy on average around 9.1 years. What is 1.4 year as compared to 9.1, right? Okay, so key is in longer term, equity markets tend to trend higher and they will reward those investors with patience and prudent investment. For those of you who have been through the past few market crises, I know you have understand that market will eventually reflect its fair valuation. The actual valuation will definitely fair across long term, because why market will fair when companies within the index uh, improve in their earnings, right? Their earnings will strengthen mainly by the increase in population growth. More population will translate into more consumer spending, more consumer buying your products, more consumer will produce. So this expansion, this growth will help in improving the company's profit. So, but I couldn't deny, although it's pretty difficult to stay invested across longer term, knowing that you will face the up and downs in the market. Uh, what more, looking at the losses, looking at the rates in your holdings, historically, we have proved that market will always reward for those long-term investors. Okay, in this chart, similarly, we have stressed this over and over again in, I think, in almost all our webinars. This included the recent COVID-19 sell-off in the lowest in 23rd March. From the past 10 years up until now, this is S&P 500. Yeah, from the past 10 years investing in S&P 500 up until current period, investor who has invested, stay invested, will enjoy annualized return of 10.8% compounding each year. However, in one extreme case, if one try to time the market, like for example, frequent entry and exit of the market, get out and buy whenever they think the market is low, uh, by just missing out the 30 best days, they would have end up in the negative territory by now. 30 days out of 10 years, that's about 3,650 days, and around 0.8% of 10 years. You just miss out 0.8% of the best opportunity. You already end up in a negative. So look at the significance in timing the market. So jumping in and out of the market may cost you, I would say, may cost you big time. All right. And okay, if you follow my webinar, my last webinar about how to protect your investment during times of crisis, I also share this chart, which I compute S&P 500 in purple color and also S&P 500 volatility index, which explains a lot about opportunity that you get to enjoy in any given market uncertainty. Those highlighted in yellow and in orange color is market crisis back in 2019, 2018, oil crisis, this one 2011, and also the Asian financial crisis. Asian financial is not here. Okay, this one is subprime mortgage. Okay, if you see in every peak of volatility index, S&P 500 will decline to, I would say, to uh, at least 1 or 2 year low. Yeah, right? As you can see here, peak, low, another peak, another low, another peak, another low. This indicates that in every market uncertainty, in any market crisis or financial crisis, there's a good chance for you to average down your investment and exercise dollar cost averaging, so that you get to pull down your weighted average cost, like I showed you earlier, and stay invested in longer term, so that you get to enjoy this uptrend. All in all, yeah, as you can see, over the long term, most markets actually looks like a rising chart like this. I wouldn't deny that, but then there's a good chance that if you were to invest all at once at the very beginning, like how I explained earlier, you may actually enjoy a better return. But I think that is another case, because not all of us have the ability to accumulate a huge sum of money we think sufficient to sustain us until our retirement and invest all at once at a particular time and just let it be. We don't have that premium. We don't have that opportunity to do that unless you have you get from inheritance, or you get it from insurance reimbursement, or even winning a lottery, then you get to do that. But consider most of us derive most of our investment capital from our salary, from our business profit, from our let's say investment profit, so on. We have to consider doing dollar cost averaging and invest over time. Okay, that even if you do have a huge sum of capital and invest it one lump sum, let's say here at the very bottom here, that at least if you really have a steady emotion, you really it really can have the ability, inhuman ability to ignore the emotion. You're able to ride through the up and downs of the market. For those of us who don't have the nerves of steel, investing over time can actually help us to relax, stay invested while riding through any market turbulence with peace of mind, and I think can enjoy a very successful investment experience. Okay, right. With that, I think I've come to an end of my sharing. Probably I'll open around 10 minutes to answer your Q&A. If you have any, you can just type in the Q&A section. I'll just answer them, or my colleagues, Sean or Jenna, will also answer your question. Okay, I can see some already answered. Okay, I'll take few questions from the open Q&A. Okay, if I have 100,000 waiting to be invested in USA related UT now, should I invest 50 now and gradually in interval of 1 week in between till it is used up? My question is, what is the best way to allocate this pool of money, and any research done to share with us? Okay, yes, there are research done to share with you on how you should allocate this. The prudent way, or the I would say decent way for you to start, we will recommend you to practice portfolio strategy, which is the 50% that you want to invest at the very beginning, allocate into few different markets, few different sectors, both in equity and fixed income. Practice a diversified portfolio, and your subsequent investment that you want to invest later on, you top up into, for example, those that having losses. For example, you invest now, there will be probably one or two funds that not having profit. For sure, if there are a few funds that is going sideways, negative, you can top up into those negative one. But all in all, make sure that you know your risk profile. You construct a portfolio which well represent your own risk tolerance, and also know your initial allocation of portfolio, so that whenever you top up, whenever the market perform in, let's say, next 2 to 3 years, the portfolio allocation has deviated from your initial allocation, you get to do rebalancing and rebalance your portfolio back to your initial allocation. That is how, not to say the best way, but the recommended way to do it. The Excel sheet looks good. Do you mind sharing with us? Sure. You may email to us from my slide, investor.com. I can share it to you, no problem. Sriram, this is true in a falling market, but may not be true in rising market. Yes, as I said, not all strategy, can be deemed as the only best strategy in any given time of any given period of time. During a certain market condition, during certain market, volatility, some strategy might work best, but some might not. So given any strategy in financial or investment side of things, there's no one absolute strategy that can be deemed as best. You are right, this is true in a falling market, but not true in the rising market. Okay, but all right. Another one, can we download your WC worksheet? Yes, can. You can. I can share it to you. Please email to us, and I'll share with you. Michael Chong, the example shown are always long-term uptrend. of Dow Jones and S&P 500 with short-lived bear. How about KRC chart? Have you plotted the same? Okay, why in the first place, why we use S&P 500 or in some Dow Jones is because that is usually the benchmark or the market benchmark that we refer to, or the fund managers refer to, or the investment players refers to when it comes to assessing the equity market trend, because that is the I would say the global leader in terms of equity market. uh, to see the overall trend, we will use the example of S&P 500 or Dow Jones. If KRSC chart, if you want to particularly focus on Malaysia, uh, you may do so. You may email to us. Our CIS will also share with you how our KRSC chart fares in the long term. But I've seen one research done on it. I've seen one chart which uh, you know uh, explains what your concerns. The result is the same. I would say the result is pretty much the same. Okay, from BK, in which market cycle does DCA works well, and in which cycle it works marginally? Given most investors are expecting a prolonged U-shaped recovery with lower and longer returns as current economic sentiment portends future equity upside, do you think we should stress our DCA frequency to particularly observe for any rebound or bottoming out before we ride the bullish upside? Um, to be honest, no one and no any entity could tell when the downside of the upside will end. So if you think uh, whether or not you should stretch your dollar cost averaging frequency, that is, I would say that is depends on your own ability, depends on your own capital size. Some of us might have 5,000, some of us might have 10,000 or even 100,000 to capitalize. So those with bigger amount of capital, they get to stretch their DCA even longer, or they can even increase their frequency if they want to. But for most of us, which do not have much of capital, there are limitations that is that we need to consider. But all in all, rebound or bottoming or any bullish upsides, that is, if historical is any guide, like I explained earlier, any bear market will follow by a bull market after that, regardless 1 year, 1.2 year, or 1.4 years afterward. All right, I hope that answers your question. Hi, some trading courses do not advocate dollar cost averaging. What would be your comment? I think I've answered this earlier. Not dollar cost averaging or any particular strategy, even it's not deemed to be the best, and it's not deemed to be like have the exhibit some ability to generalize all investment instruments. Okay, can we use DCA on stock too? Yes, you can definitely. Between DCA versus yearly portfolio balancing, which will better? This is not A and B. It's actually A with B. All right. DCA and yearly portfolio balancing is not how to say. It's not substitute. They don't substitute each other. They complement each other. After doing DCA over the long term, you realize your portfolio is making profit, and you have your current portfolio allocation has deviated from your initial allocation. That's when the time you have to do rebalancing. So it's not do DCA and not rebalancing, or rebalancing and not DCA. So it works. It complements each other. Okay, Michael Chong again. What if the fund is downtrend since launch? How DCA works in this case? At the very first place, at the very first place, if the fund is having downtrend since it is launched, I would say something is wrong with the fund, and you have to figure out with us uh, what is wrong with the fund. Uh, Anyone is managing the fund? What is the fund manager is currently doing? How's their strategy moving forward? Because like how we assess a fund, we also will assess their sustainability over the long term. For example, 3 to 5 years. That's the first criteria. Second criteria, we will assess their volatility, the risk volatility, and the third criteria will assess the cost efficiency. We will see which costs tend to incur lesser annual expense ratio. So we will recommend it to client after assess these three elements. So if the fund does not fulfill all these criteria, they are not sustainable over the long term, they are also very volatile, and they're also very very costly. So something is wrong with the fund, something was wrong with the fund. So you need to figure out with us what is wrong with the fund, and maybe look for a more performing fund in the peer, among the peer. Okay, Colin Ng, this is different school of thought with value investing or could go hand in hand. I would say could go hand in hand, because before you do dollar cost averaging, before you investing a fixed amount of money into any particular fund or any particular market, you would want a market with good value. You want a market or a fund with a good fundamentals. So prior to dollar cost average, like I said, you need to have little understanding or little research on whether the market is good in the long run before you put your money in, because you don't want to blindly choose any fund to exercise DCA. Okay, I think okay. Maybe we answer one or two more questions. Okay, Seb, about managed portfolio, would it be better to invest a lump sum or monthly basis, assuming I have 30K? Should I average the 30K investment throughout the year? I think I pretty much answered the question as well. Similarly, managed portfolio or your own holdings that you exercise a diversified strategy, a diversified allocation, it is similar. You can invest lump sum at one time, or if you want to opt for DCA, you can also invest regardless monthly basis or weekly basis or quarterly basis, up to you. All right. Referring to my question, the immediate 50% and then every week afterward is just it's just out of the blue suggestion. Any better way? Mm, for now, if you ask the recommended way, that would be the one. All right. But regardless, 50% or 30% for the start, 20% for the start is fully up to you, and also your own risk tolerance, your risk profile. We will need to assess your risk profile to see which category that you fall into, be it conservative, aggressive, or even balanced. From there, only we can construct a portfolio that suits you. Then only we can figure out what are the funds required, what are the funds suggested to be included, and considering some funds need to begin with 1,000 minimum investment amount. Some fund can be 500. Some fund can be uh, 200 or 100, for example. So your initial capital is muchly based on depending on that. Right, maybe I'll take one last question. What's your view on value averaging? Will it be better than DCA? Okay, I've no like how to say in-depth research on value averaging, so I probably wouldn't give you one exact answer, because I need to do some research on that. But the key thing is, like I mentioned earlier, whether or not one strategy, like for example DCA, is better to another, that is the second point. First point is we should keep our option open and figure out, try to study, try to examine in which strategy works best during what economic condition. Certain market condition might be suitable to exercise this, for example, A strategy. Certain market condition is more suitable to exercise B strategy. So probably the question is not which one is better, but which one is more suitable. Okay, I think the rest of the question, if that I couldn't address, if you want to be, if you want your question to be answered, you can email to us at the investhub.my@fundsmart.com, and talk to any of us, any of our CIS. You can also call any of the hotline in KL and Penang or KK. We do have JB, but currently the line in JB is down, is under maintenance. So you may speak to any of our CIS in other region as well. We can also assist the same. Okay, so I think with that, I will conclude my sharing today. Thank you so much for your time for joining me today, and I hope my sharing this help you a little bit. If not much, a little bit will do, and hope you enjoy your investment journey with us. And with that, thank you so much, and see you. Bye bye.